Howdy, folks. Welcome to Liberty Call. Today is Wednesday, September 13th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It's a pretty nice day here in Colorado. A little bit of sun, a little bit of clouds, but not too hot, not too cold. So hope everyone, like I said, is doing well out there. You can see my boy Jake back here pacing around. He is patrolling DSA Financial Group, making sure headquarters is safe. So he's on the job. All right, kind of a meh day in the markets. Couldn't really find a whether or not things were going to head up or down. So kind of a mixed here domestically, and I see a lot of red across Europe and Asia. So again, not real exciting or positive news out there. So, all right, if it's your first time watching Liberty Call, thank you very much for being here. If you could give me some thumbs up, likes, shares, subscribes, follows, press that notification bell so we know when I go live. And let's go and jump into the numbers. All righty, Dow Jones was down 0.2%, 70 points, closed at 34,575. The SP 500 was up 0.12, closed at 44.67. NASDAQ was up 0.29, closed at 13,813. The VIX was down 5.27 today. It's at 1348. Canada was up 0.28. Brazil was up 0.26. And Mexico was down 0.74%. In Europe, Germany was down 0.39%. The UK was flat, down 0.02%. France down 0.42%. Netherlands down 0.24%. Spain down a third. Italy down 0.36%. Switzerland down a tenth. And Portugal down a third of a percent also. Russian exchanges both red today. The MOEX down 0.56, RTSI down 1.81. And the overnights, the Nikkei in Japan was down 0.23. Australia was down 0.74. New Zealand was down 0.05. In China, the Shanghai was down 0.45. The Shenzhen component down 1.14%. China 50 down 0.23. DJ Shanghai down 0.58. Hang Seng down 0.07. And the Taiwan weighted came in up 0.85. So kind of the lone outlier there in the Asia Pacific region. So anyways, all righty. So kind of like I said, kind of a mad day. Nothing's, everyone's probably waiting to see what the Fed's going to do next week. Yeah, the Fed meeting will conclude next Wednesday. So I figure a lot of folks are just kind of sitting on their hands between now and then, waiting to see what is going to occur. All right, let's get to the market recap. Tech stocks rise after inflation report as investors look to Fed meeting. U.S. tech stocks experienced gains as the annualized core inflation reading for August met expectations, sparking optimism that the Federal Reserve might be approaching the end of its interest rate hikes. While the three major Wall Street indexes closed lower the previous day due to significant losses from Oracle, Wednesday's focus was on U.S.'s Consumer Price Index. Investors are closely watching this data to gauge the likely path of U.S. interest rates for the remainder of the year. The annual headline inflation rate in the United States increased by 3.7% in August, slightly surpassing the expected 3.6%, largely due to surging energy prices. However, the core reading, which excludes volatile items like food and fuel, because we never eat or drive, rose by 4.3% in line with expectations. On Thursday, investors are awaiting readings on producer prices and retail sales, which could provide further insights into the economic outlook. In the corporate sector, Moderna and Pfizer were in the spotlight after Centers for Disease Control and Prevention recommended updated COVID vaccines from both companies for all Americans ages 6 months and older. Yeah, because it really, kids need that sort of stuff. Moderna shares rose by 3%, while Pfizer experienced a minor dip of 0.1%. And go out there and get those shots. Because these pharma companies, these guys got to eat. You can't expect these, corporate, people to survive on just a few $1 million a year. Come on, folks, help them out. All right. Apple also remained in focus following its annual hardware event, where the tech giant unveiled 4 new iPhone models. However, the company refrained from launching major updates to the flagship device's design or software, leading to a slight dip in its shares. Oil prices edged higher, nearing their highest level since November of 22, driven by ongoing supply concerns and a positive demand outlook outlined in the OPEC monthly report. The report suggested that oil markets would further tighten in the coming year due to robust demand and reduced production. Additionally, the Energy Information Agency indicated that global oil inventories were expected to decline by nearly 500,000 barrels per day in the second half of 23. This overshadowed data from the American Petroleum Institute, which showed a 1.2 million barrel increase in U.S. crude inventories the previous week. The official report from the EIA was expected later in the session. Just to give you some perspective, 1.2 million barrels a day increase. It's kind of a drop in the bucket for here domestically because we go through about 20 million barrels in America just for gas, electric, and all the other stuff we go through. So, all right, well, that was everything there. Let's dive a little bit deeper into the inflation numbers. This comes from Zero Hedge. U.S. CPI surges more than expected in August as gas prices soar. All right. The U.S. Consumer Price Index for August indicated an acceleration in inflation driven primarily by surging energy prices and healthcare methodology changes. While the headline CPI rose 0.6% month on month as expected, it pushed the year-on-year change to 3.7%, up from the previous 3.2% and surpassing the expected 3.6%. This marked the largest monthly increase since June of last year. Several factors contributed to the increase, including a notable rebound in airline fares, which rose by 4.9% following 2 consecutive months of decline. However, the most significant contributor was the 10.5% month-on-month jump in gasoline prices. Interestingly, this surge in gasoline prices coincided with the CPI index level at the beginning of Russia's invasion of Ukraine. Since President Biden took office, this index has risen by 78%. Core CPI, which excludes volatile items like food and energy, also rose by 0.3% month over month, exceeding expectations of a 0.2% change. However, the year-on-year change declined to 4.3% as expected, down from the previous 4.7%. Shelter inflation saw a decline, with August rent inflation at 7.76% year-on-year, down from 8.03% in July, marking the lowest rate since November. Similarly, shelter inflation for August was at 7.27% year over year, down from 7.69% in July, and also the lowest since November. Notably, transport overtook shelter as the largest driver in core CPI, potentially impacting stocks and bonds. The Fed's preferred inflation signal, core services CPI, ex-shelter, experienced a significant increase of 0.53% month over month, the most since September of last year, while remaining above 4% year over year. In terms of goods and services, goods inflation slowed, reaching its lowest point since July of 20, while services inflation remained high. Gasoline prices played a substantial role in the monthly all items increase, accounting for over half of the rise, alongside continued growth in the shelter index. In conclusion, the August CPI data showed an acceleration in inflation driven by rising energy prices and healthcare changes. This poses questions about the ongoing debate between inflation and the possibility of a disinflationary soft landing, highlighting the uncertainties in the economic landscape. And if you remember yesterday, we talked about, I covered an article about the certainty of a bunch of economists that we're done raising rates and that we're going to start slashing rates going into 2024. So we'll see. I mean, they didn't provide any proof, and I know I pointed that out yesterday. So we'll see. I mean, are these people right, or are they completely off base, just trying to wish things into existence? All right, last up, it's an article from Mises Wire titled Inflation, Government's Insidious Form of Theft, written by George Ford Smith. Let's see what he had to say. All right. The United States' monetary system has come a long way from the days when debasing gold or silver coins could lead to the death penalty, as established by the Coinage Act of 1792. Likewise, the concept of gold and silver coin as tender of payments of debts, as outlined in Article 1, Section 10 of the Constitution, has become largely irrelevant. Instead, the nation has embraced a, quote, gold standard for monetary policy, which involves inflating the currency at a rate roughly 2% per annum. This inflationary policy is now solely under the control of the Federal Open Market Committee of the Federal Reserve System, granting it a monopoly on money creation. In essence, the U.S. government no longer views gold or silver as money, but rather issues paper bills and their electronic equivalents as money itself. This has placed the United States in the unusual position of being a counterfeiter, with the government holding a monopoly on this counterfeiting process. The Federal Reserve's role in the monetary system is crucial, as it has the power to create money and control the money supply. Moreover, the Fed employs numerous economists and researchers who play a significant role in shaping monetary policy and maintaining its stability. I believe there's like 400 economists that work for the Federal Reserve. So it's not like it's just a handful of people. I mean, that's a lot of folks who have economic backgrounds who get it completely wrong all the time, which is even more puzzling. I mean, 3 years ago when they were printing all that money or talking about it, no one raised their hand and said, increasing the money supply is really going to create a lot of inflation. We probably shouldn't do this. And I mean, what did everyone else turn to and throw them out the window, like in that meme about how to improve morale at the company or whatever. Anyways, let's see here. This has led to the economics profession being influenced and in some cases co-opted by the Fed. In contrast, cryptocurrencies like Bitcoin have gained popularity due to their finite supply, which prevents inflation and can lead to deflation. This is in stark contrast to traditional fiat currencies, which are subject to constant inflation. The Fed currently faces significant challenges, including dealing with the government interventions in the economy during the COVID-19 pandemic and attempts to rebuild the economy with a focus on a woke agenda. This central bank aims to curb inflation, particularly in essential areas like gas and groceries, while making housing more affordable. I'm not sure how they're going to do that. However, the Fed's efforts to combat inflation may resemble a drunk trying to quit drinking, but still being in control of the vehicle in which everyone is a passenger. Inflation, characterized by an increase in the money supply imposed by the government, can have detrimental effects on the economy. These effects include reduced purchasing power, discouragement of savings, market distortions, and economic instability. Overall, the practice of inflation, which allows governments to fund themselves through the creation of money, poses significant challenges to economic stability and democratic principles. It is a complex issue that warrants careful consideration in the ongoing debate over monetary policy and the role of central banks like the Federal Reserve. Personally, I like to just get rid of the Federal Reserve, go back to gold and silver as coinage. I don't have a problem with Bitcoin, but it does have some issues that I have problems with. Like if you die and you didn't give someone access to your private keys, what happens to those Bitcoins? So, anyways. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope you have a wonderful evening, and I'll talk to you next time. Adios.